Greetings, my friends. I wanted to make today's video because my mentor Romulus was noticing that I was buying a lot of oil this past week, and he wanted me to pitch kind of my bull case for oil. So that's what I'm going to do in today's video. I'm going to go over the bear case for oil, the bull case for oil. We're going to do some technical analysis, and also I'm going to talk about how I'm going to manage my oil trades for 2024. And then lastly, I'm going to give some stock ideas, some individual stocks that could potentially run up for 2024. So first up, I wanted to really talk about Celsius. Celsius, it's a really good drink. Gives me a lot of energy. We'll talk about Celsius stock as well, but I'm really enjoying it. But when we're getting into oil, basically I want to go over the bear case first. The bear case is if there's a decrease in demand for oil and or there's an increase in supply for oil. So if there's going to be an increase in supply, more oil is going to be drilled, that's going to potentially drive oil prices lower. Or if there's not going to be too much demand for oil, it could be like a type of like recessionary type of deal where there's just not as many people driving as much, or there's an economic slowdown that could potentially decrease the price of oil. And regarding the chart, there's a critical support level, as you guys can see right here. It's kind of about $66 a barrel. We're looking at crude oil futures on the daily time frame. And notice how this support has been a strong demand. Bounce out of that, higher low, a nice good rally into the end of 2023, but then a decent drop. And actually we caught this drop on oil. We caught a little bit of this bounce on oil last year. So last year I traded oil very, very well. So I plan to trade oil very, very well this year. But if oil breaks this $65 a barrel, then yeah, oil can drop. If it doesn't though, then we could be looking at something like a type of rounded bottom in the short term, but a little short term inverted head and shoulders we can take a look at as well. Left shoulder, head, right shoulder. Here's kind of our neckline right here. So if oil breaks out above $80 a barrel, that can be very, very bullish. Okay, so that's sort of the technical aspect of it. Inverted head and shoulders, you've got a break of the downtrend line and a daily close above it. We can take a look at some other indicators as well. I like the money flow index and the volume weighted MACD. So the money flow index, just a quick reminder, it's just like an RSI multiplied by volume. The volume weighted MACD, same thing. It's just like a regular MACD, but it's multiplying the prices by volume as well. So right over here, we've got bullish money flow confirmation right here. So higher highs on the money flow, and price hasn't even made a higher high yet. That's actually really bullish because it's telling us that there is demand for oil. Okay. And the volume weighted MACD, we got a buy signal, back in late December last year. And that's kind of just forecasting sideways to slightly higher. So if the money flow index had been trending lower, then I wouldn't be as bullish on oil. Okay. So when we're looking at this, the way that I'm trading oil is I'm doing cash secured puts right now. I think that this could be somewhat of an accumulation zone. Okay. So what does that look like? Well, cash secured puts, you get paid to enter your stock or to enter your trade. So one way I'm doing this is through UCO, and UCO is 2 times levered the price of oil. Okay. So 2 times. So that means if oil goes up 1%, UCO goes up 2%. If oil goes up 5%, UCO will be going up 10%. It's not always going to be perfect. There is decay as well. We're not going to get into decay and stuff like that today. But essentially, when looking at UCO, I like the option prices, UCO, because you can sell cash secured puts. And that's exactly what I did this last week. I sold the 25.50 strike cash secured put, collected about $35 in credit per put sold. And then what that means is just like, okay, if it's above the price of the put that you sold, you get money. So this profits whether oil goes sideways. It profits if oil goes up. It profits if oil moonshots. It profits even if oil goes slightly lower. It just doesn't profit if oil absolutely crashes and then I get assigned and then I'm underwater on the shares. And that's okay. That's the risk of trading. Not everything always goes according to plan. Another way that I'm trading oil is through USO. And USO, the options are a little bit more liquid. It's a little bit better than UCO. So if you want to trade oil, you go to USO. And that's just, the bid-ask spreads are generally a little bit tighter, especially when you trade at the money on UCO. So I'm looking at 2025 call options if oil can break out up. Until then, though, I'm looking at the cash secured puts. You can do bullish put credit spreads, you name it. Okay. So one other thing to just note with oil is that there can be like a lot of gaps and big gaps. So price shocks. And that's just something to note that, you know, it's really news driven. There can be a lot of economic changes. There can be changes in supply and demand just overnight. OPEC has a big influence on oil. War has a big influence on oil. So just be aware that, you know, the way that I'm going to be trading this is I'm not going to be married to the long. I'm going to sell into big gap ups. Okay. So if there is going to be like a big price shock upward or something, like maybe something like this, like, look, price closes out on USO at 66.42, gaps up to 70. So that's a 6% increase in one day. On a day like that, I'll probably sell the call options and look for a place to reload. So I'm not going to be too married to the oil trade. And conversely, I can't oversize into this because there can be big gap downs as well. So I'm aware of the risk of commodity prices and commodity fluctuations. And that's just going to be an important factor with the trading. Okay. So on gap downs or oversold conditions, I might look to buy oil if I don't have a current large position. So I'm going to be wheeling UCO and I'm going to be trading call options on USO. Okay. So UCO, what's cool is you can also buy 100 shares and then you can do something like, you know, sell a call option. So I could buy 100 shares of, and you can also do this with USO. UCO is just a little bit cheaper and you get a better bang for your buck because you're using a little bit more leverage because it already is double levered. But you can buy 100 shares of UCO. That'll cost you $2,750. And you can go out and you can sell the February 2nd, like, you know, 31 strike call. Maybe you can get like an extra $70, 0.70 of credit. Or you can just do it weekly. You know, I like to sometimes look at the option chain and notice, hey, there's a little bit of skew here. And what do I mean by that? It just means where does the expected move right over here change the most? So I see a big jump right here. Okay. Then I don't see a big jump right here. And you also have to compare the expiration dates as well. But just taking a look at the option chain, where can I get the most premium? Okay. So the management right now for oil is going to be cash secured puts and then buying call options if we can get that breakout. So if USO breaks out over 71, that could be an interesting development. You do want to look at CL, crude oil futures, because that's the underlying thing that USO is trading off of. Okay, so now let's get into some individual stocks. So ARLP, this is a coal producer. I really like this stock. It pays about a 12% dividend, and I've been accumulating this for a while. I've been wheeling it so you can sell cash secured puts on this. And it's not exactly oil related, but it is energy related. And, you know, you could do something like Jan 19th. You can't probably sell the 20 strike put, although I have that position open as well. So that's probably going to expire for maximum profit. But if ARLP can like get down to like this 20.30, that could be a potential little dip buy. Or if you just want a dollar cost average this, you know, this is not financial advice, by the way. This is just me telling you guys what I'm doing. You make your own investment decision. Okay? We got it? I'm going to take a sip of Celsius. Otherwise, if ARLP can potentially, you know, consolidate sideways and then break up, that can be another buy point. And again, you could do something like buy 100 shares and sell the 22.50 strike covered call. Collect an extra $10 to $15, depending on your fill, and you're good to go. And one other individual stock I'm looking at to wheel is going to be ET, Energy Transfer. And Energy Transfer, it helps with the transport of the natural gas pipeline. So this is a pretty important company and important stock. And I think that it can potentially, break above these highs. And even if it stays range bound, you still get a really good dividend. I believe the dividend's about 8% on ET. So 8% dividend, combine that with, you can do, let's do ET right over here. So ET, you can take a look. Yeah, not too big of option premiums on this, but, maybe you can sell some cash secured puts, and if you get assigned, it's a win. And if you don't, that's fine too. So take a look at ET for dollar cost averaging. In terms of other just inflation type of trades, because if inflation goes hot, oil can also break up. So you're kind of protecting yourself against inflation. If there's something like deflation or not a lot of inflation, yeah, oil prices will drop, but that's okay. I mean, you'll hopefully have more purchasing power then in that case. But some other inflationary trades could be wheat. So if wheat breaks above 6 and more decisively 6.14, I do think that wheat could potentially run probably as high as 9. That would be a 45% increase. That's a stretch target. Really, the measured move for something like this would be like a 14% move. And you just duplicate the flagpole, and that'd be something like 662. So wheat long over 616, target that 662. You can trail stop that, or you can set a stop underneath 567 if you just want a hard stop, or just want to have your R multiple kind of set where you risk 2 to make 4, whatever it may be. So that's just a hard R multiple, hard stop loss, hard take profit. Or I like to trail stop, so buy the breakout, and then you trail stop up as it moves into your favor. So that's wheat. URA. I wouldn't wheel wheat just because the bid-ask spreads are a bit wide. So that's just something to consider. I wouldn't wheel it, but here's wheat. Another one is URA, so uranium. You can wheel uranium. And again, this is another energy type of trade. But again, if the premiums are good and you can get a good fill, maybe sell the 2550 strike put expiring next week, and you get to own it at 2550 and you get paid to own it at 2550. And you're kind of coming into this support area. There's a good consolidation zone right there. So that's another idea. And those are the main things that I wanted to talk about today. Lots of really fun stuff going on. We got a lot of good trades that are rolling. I'm excited for 2024. It's been an amazing week already. I got my booty kicked in November last year, but now it's just all coming back and then some. So I'm super excited. Let me know if you guys have any stocks or questions you want me to answer. And yeah, I'll see you guys later. Peter says hi as well. I don't know if you guys miss Peter. He's been hanging out right over here. Look at his shoulders. Kind of looks like a chicken, doesn't he? Like a rotisserie chicken. He's just kind of hanging out. He's sleeping on my sweatshirt. Peter, what's up? He's just hanging out. Oh, one last thing too. I've also I submitted my final application to become a chartered market technician. So I'll keep you guys updated when that occurs. So that'll be a lot of fun too. Okay. Peace out, you guys. Or PAX.